This year's budget shocked the industry with the dramatic changes it proposed to super tax concessions. Here to talk about what the changes mean for advisors and their clients is FPA Policy Manager Dimitri Diamantes. Dimitri, thanks for joining me.
Pleasure.
Now Dimitri, what is the FPA's view on the changes? Do you believe it's going to be an overall positive or a negative for the majority of advised clients?
Yeah, so I don't think we can neatly pigeonhole the budget into one of those categories. I think it's going to be challenging. There are certainly positives and some very challenging features. On the positive side, there will be changes that will make it much easier for spouses who aren't working or have broken work patterns to boost their super. For example, the ability to carry forward unused concessional contributions within their cap from previous years, and the ability for working spouses to make, or the primary earner to make contributions or claim a deduction for a lower income earning spouse. So positive on that respect, in that respect. On the more challenging front, we've got, for example, changes to TTR, the removal of the tax-free earning status of TTR pensions, which certainly weakens the benefit of TTR and income replacement strategies. Combined with that removal of the tax-free exemption, you've got a reduction in the concessional contribution caps, and both those things weaken the strategy. And this strategy was particularly important for middle income earners because the benefits were very available to them because they hadn't used up their concessional cap with their superannuation guarantee, so there was a lot of scope to get some upfront tax benefits from this strategy, whereas with the reduction in the concessional contribution cap, that will really tighten the ability to get upfront tax benefits from the strategy. In addition, we've got proposed changes to the ability to put money or transfer money from the accumulation environment into the retirement income environment. And from a practical point of view, I think there are going to be lots of administrative issues in trying to manage that. For example, people starting multiple pensions, the obvious intention is that your total superannuation balance going into retirement phase could only be 1.6, but there's going to have to be a mechanism for ensuring that multiple fund balances are aggregated, and we've seen in the context of non-concessional contributions, for example, over the years, the difficulty of managing information across multiple funds. Another big issue, of course, one that's really being talked about a lot, is the lifetime cap on non-concessional contributions, and advisors are going to need to get access to information going back 10 years to start with, and going forward that time will be ever increasing. So what do you do in relation to closed superannuation funds, for example? There's a very urgent need, if the measures go through, to have ready access to a centralised source of data that's reliable. And at the moment, my understanding is the ATO does have that information, but there's a lag between when the ATO gets that information, and one, when they can make it available, and two, what the kind of lag time is between when they receive the information and when they can actually distribute it to advisors and consumers. So certainly lots of challenging issues.
And what will the changes mean for the way that advisors are approaching their clients' retirement from a planning perspective?
There are a couple of angles there. One is, given for example, the proposed transfer cap on balances that can go to retirement income phase, as well as the lifetime cap on non-concessional contributions, there'll be greater emphasis, I think, on strategies that split benefits between spouses. So for example, you've got two spouses working, there'll be greater incentive to build up both spouses' balances rather than having a huge disparity between each spouse. Of course, there are challenges there, because with broken work patterns, one spouse will typically be having time off work without the income to contribute. However, with some of the other measures, for example, the ability to claim tax deductible contributions to super regardless of your income status, your employment status rather, the ability to get enhanced benefits if you're contributing for a spouse, they will help boost a lower income earning or a non-working spouse's retirement benefits.
And just going back to your point around the transition to retirement pensions, given the changes around this strategy, would you advise planners to avoid it in future?
No, not at all. There's still a great scope for getting benefits. What's been removed is one aspect of, or one benefit of the strategy, namely the ability to transfer assets from an environment where the earnings are taxed to an environment where the earnings aren't taxed. That benefit's removed, but there's still the ability to get upfront tax deductions through withdrawing money from a concessionally taxed environment. The income received from a TTR pension, a transition to retirement pension, is still taxed in the hands of the recipient at the same rate. It's just the earnings on the pension that are no longer as concessionally taxed. So there's still a benefit from drawing money out of that pension because it's still very concessionally taxed. And of course, the money drawn out of the pension can be used for a client so that they can continue to enjoy a good standard of living, and it frees up some of their salary income to be put into superannuation. And because of a tax differential, the client can actually boost their super quite significantly. There is something to watch out for though, and that's where you've got clients who are already contributing close to their concessional contribution cap. For those clients, even if they're over age 60, the TTR strategy isn't going to deliver any benefits because the only benefit now, the only source of benefit, well, from 1st of July 2017, if the measures go through, will be that upfront tax arbitrage, and that will there will be no tax arbitrage benefit where a client is already contributing at or near, or at or beyond their cap.
And in terms of the changes to contributions caps, should advisors be looking at the advice they've given clients in this area, particularly given that there are no grandfathering provisions around some of the changes?
They should, and to give you an example, a particularly powerful one, let's say that an advisor recommended that a client make a $540,000 contribution, and day after budget, let's say the 4th of May 2016, the advisors received an application form to make a $540,000 contribution into a super fund. What does the advisor do? On the one hand, under the law as it currently stands, the client could make a $540,000 contribution on certain assumptions, and they would be within their caps. But if the proposed measure comes through, it would be retrospective, and 40,000, or at least 40,000 of that 540,000 would be excessive, and there would be consequences of having excessive non-concessional contributions. So I would imagine that most clients, having had a discussion with their advisor about the changes, which I think all advisors should be initiating, would say, okay, just put in the 500. But some clients, having had that conversation with their advisor, might say, look, I'm willing to take the risk. What is the risk to me? I might be in a position where, for example, I need to pull $40,000 out of super, and any associated earnings would be included in my assessable income. We understand that that's the treatment that would apply to the excessive amount. I guess in a nutshell, advisors should be proactively contacting clients in this situation and having the discussion about the change in circumstances and how the client should proceed.
And are there any positives that advisors can take out of this for clients? Would this be mainly around the changes for catch-up contributions for spouses who might be leaving the workforce for a time?
So if you're referring to the budget in general, yeah, there's some big positives. With a more targeted approach, I guess, to superannuation tax concessions. As you mentioned, spouses who have broken work patterns might be a big beneficiary. So you talked about catch-up concessional contributions. For an advisor dealing with a couple, it's not unusual for one of the spouses to take time off work to bring up kids. When the spouse goes back to work, there's an opportunity to really ramp up superannuation contributions. I think another big benefit, and this applies more generally, is around the ability to claim a tax deduction for personal contributions to super up until under the current rules, you need to be unemployed, self-employed or substantially self-employed to make a tax-deductible contribution to superannuation, whereas under the proposed rules, anyone whose contributions will be accepted to the super fund is able to claim a tax deduction regardless of their employment or self-employed status. So it gives people a lot of flexibility. They don't have to make a commitment right at the start of the financial year or partway through to make, for example, salary sacrifice contributions to super. They could decide towards the end of the year, hey, I want to make an additional contribution to super. I want to get the tax deduction. I'm going to put a large amount in now, for example, and I can still claim the tax deduction. So a real benefit for them. Another benefit for older Australians is that they won't have to meet a work test in order to contribute, whereas under the current rules, once you've hit age 65, you need to meet a work test every year, and that can be quite challenging. With the new regime, the new proposals, a client could contribute income to superannuation regardless of its source, regardless of whether they're working, and they could potentially claim a tax deduction, but just as important, they wouldn't be restricted simply because of their age in making the contribution to superannuation.
And are there any actions that advisors need to immediately take with their clients in light of what's been announced?
Yeah, look, I think there are a couple of big take-homes. One is for clients who have, for example, just acted on a piece of advice to make a large non-concessional contribution to super, but the cheque didn't hit or wasn't about to hit the super fund until after the budget. There's an issue there. Advisors have to speak to their clients about the implications of the budget and find out from the client whether they want to take that risk and put the full amount into superannuation, or whether they want to take account of the new lifetime cap. Another big take-home is to review TTR strategies. Whilst the reforms won't come into place until 1st of July 2017, it's important to start looking now, because as we know, it takes time to arrange meetings with clients. It's important to start looking at rejigging the strategy where it's appropriate, for example, where clients are already close to the 25k mark in terms of their concessional contributions. And another big issue around TTR strategies is clients' retirement outcomes were based on the assumption that they could continue to contribute and would continue to get the same sorts of benefits as they've been getting under the current regime. Suddenly those benefits are scaled back. It's a good time for advisors to, even now, to start talking to their clients about what that means in terms of their retirement outcome, and whether it might be a prudent time to start increasing other types of contributions to super, for example non-concessional if they haven't already, and also looking at strategies outside superannuation to help build their wealth.
Great. Dimitri, thanks for your time today.
Pleasure, thank you.